Hi guys, welcome back to the channel. Today we're going to talk about Japan and what does that have to do with the biggest drop in markets. Many economists are saying it's given vibes of Black Monday. When in October of 1987, markets fell 15% and the SP 500 lost 20% of its value. You see, Japan's economic challenges begin in the early 1990s with the burst of its asset price bubble, leading to what is known as the lost decade. This period extended into the 2000s and 2010, often referred to as the lost 2 or 3 decades, due to the continued economic stagnation. The bubble's collapse resulted in a severe recession, with GDP growth averaging only 1.3% during the 1990s and remaining low in subsequent decades. Several factors contributed to this prolonged stagnation. You see, Japan's aging population and declined birth rate have reduced the labor force and consumer demand, impacting economic growth. Persistent deflation discouraged spending and investment. As the real value of money increased over time, low interest rates were intended to raise inflation towards the Bank of Japan's target of 2%. Countering deflationary trends, the government high debt to GDP ratio limited fiscal policy option, necessitating reliance on monetary policy. You see, low rates help the government manage its substantial debt by reducing interest rate payments. Despite these efforts, Japan's economy continues to experience slow growth, with GDP growing at an average of just under 1% per year from 2011 to 2019. So, investors and traders, being very savvy, started trading in what is called the carry trade. At its core, the carry trade exploit the interest rate differential between countries. Japan, with its persistently low interest rates, have been a prime source of cheap borrowing. Investors and financial institutions borrow yen at minimal cost and convert them into higher yielding currencies or assets, such as US stocks or bonds. This not only amplifies return, but also injects liquidity into global markets, including the US financial system. The yen's value is pivotal in this equation. You see, a weaker yen makes it cheaper to repay yen denominated loans, enhancing the profitability of the carry trade. So, conversely, a stronger yen can erode these profits and even lead to significant losses. Recently, the yen has been under pressure due to various factors, let's say, including Japan's economic policies and global market dynamics. According to the article from Fortune, the yen's depreciation has been accelerating, driven by Japan's commitment to ultra loose monetary policies, even as other major economies tighten theirs. This divergence has made the yen an even more attractive funding currency for the carry trade, leading to an influx of yen borrowing, right? Because Japan's currency is so devalued, the rate is so low, everybody wants to get in on this carry trade. Okay. So now this increasing reliance on the carry trade has not gone unnoticed by Wall Street. Financial experts are wary of a potential repercussion if the yen were to stage a sudden rally. Such an event could trigger a rapid unwinding of carry trade, leading to a liquidity crunch and heightened market volatility. This scenario is particularly concerning given the current economic backdrop, where the US is already grappling with inflationary pressures and interest rate hikes by the Federal Reserve. The fear of a US recession are intricately linked to the dynamics of this carry trade, because a sudden yen appreciation could force investors to sell off US assets to cover their yen denominated liabilities, leading to a sharp decline in asset prices. This could exacerbate financial instability and potentially tip the US economy into a recession. Well, you guessed it. That is exactly what we saw this week. In a significant policy shift, the Bank of Japan raised interest rates in 2024 for the first time in 17 years, moving away from negative interest rates. This decision was driven by modest improvements in wages and inflation, as well as a desire to normalize monetary policy. However, the Bank of Japan remains cautious, aiming to maintain economic stability while gradually adjusting rates. You see, though the market seems to be stabilizing for now, we're not out of the woods just yet. Recent economic data suggests that a potential recession in the United States is imminent. The July jobs report showed a rise in the unemployment rate to 4.3% from 4.1%, coupled with weaker than expected job creation, which has spurred concern about an economic slowdown. This has led to a significant sell off in global stock markets, with major indices such as the Dow, SP 500, and NASDAQ experiencing sharp declines. Now, everyone is talking about the SOM rule recession indicator, which suggests that a rise of zero point 0.5 percentage points in the unemployment rate signals a recession. While the US economy has shown some resilience, recent data points to a slowdown. GDP growth has decelerated and consumer spending is cooling, which are typical precursors to a recession. The unwinding of the carry trade could lead to a contagion effect, impacting not just the US, but also other economies heavily reliant on foreign capital inflows. The Japan carry trade, while a powerful tool for generating returns, carries inherent risk that can have far reaching implications. As the yen value fluctuates and global economy conditions evolve, the potential for disruption in the carry trade grows. Wall Street's heightened vigilance reflect the broader concern that these financial maneuvers could be the harbinger of a deeper economic downturn. I can't say for certainty exactly what is going to happen, but we have an election this year, and I fear that the Fed is holding this whole market together with just duct tape. Many economists fear that if we go into another recession, this one is going to be a massive one. All right. So that is going to be all for today, guys. If you find value in this video, please like, share, and subscribe to the channel. And please let me know what you think in the comment section below. All right. I'll see you guys soon. Thank you.